Alright guys, so we're going to get straight into this video, and if you can't tell by the title of this video, it is almost virtually a guarantee that the stock market will crash in 2023. Now you have Bank of America, Morgan Stanley, and JP Morgan all expecting an over 20% crash in 2023, and we're going to break down exactly what these three banks are saying and why they are 100% correct. It all comes down to math, the boring stuff. It all comes down to fundamental valuation. So let's get into it, guys. And this mostly went under the rug. And that's the thing that is so surprising about all of this. Nobody's talking about it. And it's probably the first time that you guys have even heard about it. But last week, on Thursday, December 1st, JP Morgan cuts their 2023 S&P 500 earnings forecast by 9%. And listen to these numbers, guys. So JP Morgan strategists now estimate S&P 500 earnings per share for next year to be $205, down 9% from an earlier forecast of $225. This has been the number that a lot of algorithms have been trading off of. This has been the number, $225 of EPS for 2023, that a lot of investors have gotten really comfortable with. And let's just go through and quickly go through some math on what the difference is between 205 and 225. So to understand the PE ratio, this is what we're going to talk about. The PE ratio is the most widely used metric of evaluating companies, especially companies that are profitable. It's essentially saying, just to dumb this down, make this Econ 101 friendly for everyone, no matter what your experience level is. Let's just say you had $100 of earnings, right? These are profits. These are booked in the bank account. Well, if your stock was trading at $1,000 and they had $100 of EPS, which is just ridiculous, right? You'd be at a 10 times PE ratio, right? $100 of earnings times 10 equals 1,000, the theoretical price of the stock. Maybe that was a bad example, using way high numbers there. That doesn't happen. We have never seen a company have $100 of EPS in a year. But nonetheless, guys, don't get lost in the sauce. What is the average PE ratio for the S&P 500? And the average PE ratio is in between 13 and 15. Sometimes during very bullish markets, like what we've seen in 2020 in the second half, obviously, and 2021, the PE ratio got excess of 20. So you were trading around 21 and a half for a PE ratio. And that was really because a lot of government spending, low inflation at the time, a lot of different factors played into that. We're not going to get into exactly why that is, but let's talk about where the S&P 500 is currently trading at. So the S&P 500 currently is trading at about 16 to 17 for the P ratio. It varies literally day to day, but we're just going to go with, let's just call it 17. And that's still two points above the historical high of the S&P 500. So it's still, take it for what it is, richly valued, especially when the federal funds rate is going to be 5% for the better half, or better part, I should say, of 2023. Now let's get into some of the numbers, guys. So the best way to calculate this, in my personal opinion, is just times this number, this 205 or the 225, by your PE ratio. So when let's do 225, the earlier estimate, and let's times that by 17, roughly where the markets are currently trading at. That gives you a fair valuation of about 382 on the S&P 500, which is very fair and appropriate. Now, let's do that same equation, but let's type in 205 for the EPS for the S&P 500, JP Morgan's new revised earnings target for 2023. And we go ahead and times that by 17. You're looking at 348 on the S&P 500. Now, let's go ahead and let's say the Fed does start cutting rates. Let's say inflation goes down and the soft landing looks to be here. Well, I doubt we're going back to those 21, almost 22 PE ratios that we've seen in 2021. Probably not going to happen. But let's be very, very generous here. And let's do 225 times 19. That's a very generous P ratio. And that would be definitely with a very low statistical probability of actually happening, right? You're looking at 427 on the S&P 500. Let's go ahead and pull up 205 times 17 or 19, and don't get lost in these numbers. We're gonna break it down to exactly what all of this means here in just a second, but I think you guys are starting to get the gist of it. So 205 times 19, that leaves you at about 390 on the S&P 500. So you can kind of start to see that these numbers just don't make sense given the S&P 500 is currently trading at around $400. So that means by and large, the markets are not expecting earnings to go down. They're still expecting earnings to grow by about 5%. And that's what JP Morgan originally had, was about 5% earnings growth for 2023. And that's where you get this 225 number. Now they're saying, forget the growth. We're going to cut our forecast by 9%. So including the growth that was priced in that JP Morgan had expected around 5%, you're really expecting negative earnings by about 14% next year on the S&P 500, guys. And long story short, based off of just logical fundamental valuations, you cannot trade even as high as we are trading for next year. You will see a major crash. And like we just went over, when you type in the 205 times 16, that's where you get the 328. Let's do it times 17. That's where you're at 348. Call it 349 on the S&P 500. That would be 205 earnings per share and a 17 times PE ratio. Well, what has JP Morgan said? Quote, they also flagged that the S&P 500 index could retest this year's low of $3,491.58 in the first 6 months of 2023 as the U.S. Federal Reserve monetary policy tightening weakens fundamentals. And they also are citing weaker demand and pricing power, margin compression, and limited buybacks, guys. And what's so similar about these numbers here? They're literally the same. 349 for the S&P and their price target of 3,491 is the exact same number. 391 on the S&P 500. That would be roughly, let's go ahead and just do this rough style here. No pun intended. Get your head out the gutter. You can see that would be a drop of about 2% from here. So not too crazy in the grand scope of, kind of what they're expecting. 17 times PE, 205 earnings. The markets are still not pricing that in, though. The markets are still not firmly pricing in actual earnings drop for 2023. Now, if we pull up the lower end ranges, about 350 is about where we expect the markets to go, about 349. That would be a drop of about 12.5% from here. But a lot of people expect that we could even drop 20% from here, because typically when you're in a crash, fundamentals, they obviously matter, but you can tend to overshoot that by a very large amount. And that is obviously what JP Morgan is expecting if we are going to retest the lows, because fundamentally speaking, if we had 225 for earnings, you're not too far off the actual fundamental valuation. The question is, do you think earnings will grow 5% from 2022 through 2023? I think the obvious number, or answer I should say, is No. And even when you're doing 17 times PE on $225 of earnings, that's still 382 on the S&P 500. I think you do have to bump that up to about 18 to get to about where we are trading at right now. Yeah, so the markets are, if this number is still what the markets are firmly pricing in, it's hard to tell on a day-to-day basis. That would be about an 18 times forward PE ratio. That would be about 4,000 on the S&P 500, about 405 to be more exact, roughly where we have been trading over the past couple of days here. So what does this prove? What is the bottom line, at least with this earnings picture? Well, earnings are going to go down in 2023. If earnings drop at all, like at all, guys, if earnings don't grow 5% and they grow at 4%, 3%, 2%, 1%, or are negative, you are in for pretty substantial downside. If we go into a recession, you're in for even more downside. And the average consensus is we are going into a recession in 2023. It's not a question of if, it is when, and how deep is it going to last. About 65%, believe it or not, of economists do expect that recession in 2023. Now let's take a look at this sweet article. From Bank of America to Morgan Stanley, Wall Street giants are expecting stocks to crash more than 20% next year. Here's what they have been saying. So it says 3 major Wall Street banks expect the S&P 500 to tank over 20% at some point next year. U.S. stocks face a recession, cuts to earnings outlooks, and liquidity risks as the Fed hikes rates. Here's what Morgan Stanley, Bank of America, and Deutsche Bank say about what could drag stocks lower. And it's basically the same. Long story short, guys, Morgan Stanley expects the S&P to fall by about 24% to between 3,000 and 3,300, which would be on the S&P about 300 to 330. It says probably in the first 4 months of 2023, its chief U.S. equity strategist Mike Wilson sees a buildup of companies lowering their earnings outlooks due to recession, which hits stock valuations. Quote, that's when we think the deceleration of the revisions on the earnings side will kind of reach its crescendo. It says the bear market is not over, he said. We've got significantly lower lows if our earnings forecast is correct. Wilson sees the S&P 500 finishing 2023 near about 3,900, but predicted a high level of volatility in the markets. Bank of America says markets will be ravaged by a recession next year, with a 0.4% drop in economic growth coming in the first quarter, according to Bank of America. It also predicts the S&P 500 could lose 24% from current levels to hit as low as 3,000 as companies are forced to cut earnings outlooks that would mark a new low in the prevailing bear market cycle. It says, but there is another risk. The Fed's quantitative tightening QT, where it trims around $95 billion in treasury bonds and mortgage-backed securities each month from its $9 trillion balance sheet, could badly disrupt market liquidity. Deutsche Bank says in its 2023 outlook that it expects global stocks to drop sharply as a severe and protracted downturn hits the U.S. economy, but it sees the slump in U.S. equities coming in the middle of the year rather than in the early months. It forecasts the S&P will rally to 4,500 in the first half, then will tank by over 25% in the third quarter as central banks tighten tips the economy into a full recession that would take the index to 3,375. So these opinions are a little bit different, but they're basically in line with the same theory here, that markets are going lower based off of earnings going lower. And that's important to keep in mind, that if you have lived through the COVID crash and the COVID hopium and then the fear in 2022, the markets can only trade off of these things for so long. If earnings would have unraveled in the second half of 2022, which they obviously did not, they continued to grow, the markets would have dropped a lot more during these low periods that we have seen throughout this year, but earnings actually held up. So the fundamental valuation is not the most important thing all the time to investors, but when shit hits the fan, fundamentals are the most important thing. And I think right now it's not the best time to be a buyer. If you have stayed out the markets throughout all of 2022 so far, I would personally wait for another correction to the downside, but I would start buying a lot sooner if you waited throughout all of 2022, guys. So those are my thoughts. Those are the actual calculations to why we have to drop in the stock market. It's literally not a question unless somehow the S&P 500 companies can grow their earnings by, say, 5%, which, I mean, that would take an absolute miracle to happen, and there would be so many people off sides that in that scenario, you might actually see new highs in the stock market, which is like, I would give that like a 5% or less probability of actually happening, guys. So that is going to be it for this video. Hit that like button, subscribe to the channel if you have not already. Thank you for watching. Most importantly, enjoy the rest of your days or nights whenever you are watching this video, and I will see you in the next one.